In this podcast episode, Peter Schiff, a prominent economist and financial commentator, discusses the critical economic issues surrounding government manipulation of the consumer price index, the dangers of high interest rates, and the disproportionate impact of inflation on different social classes. He also explores the role of artificial intelligence in economic growth, critiques the Federal Reserve's policies, and addresses the societal implications of financial instability, emphasizing the need for systemic change and greater financial education. Schiff begins by delving into the critical economic issues surrounding government manipulation of the consumer price index and its effects on public perception of inflation. He argues that the government has altered the definition of inflation, leading the public to mistakenly attribute rising prices to corporate greed rather than the fundamental issue of money supply expansion. He emphasizes that inflation is primarily driven by the Federal Reserve's actions to finance government deficits, which he views as a hidden tax that erodes purchasing power without explicit tax increases. Schiff warns that the current high interest rates could precipitate a financial crisis, particularly given the U.S. government's substantial debt levels. He explains that significantly raising interest rates would increase the cost of servicing the national debt, potentially leading to government bankruptcy. The precarious situation created by rising interest rates and high debt levels means that the government may resort to inflationary measures to meet its obligations, further exacerbating the economic challenges faced by the public. Schiff elaborates on the consequences of inflation, highlighting that it disproportionately affects the lower and middle classes. While wealthier individuals may own assets that appreciate with inflation, the average person suffers as their purchasing power diminishes. He argues that inflation serves as a mechanism for wealth redistribution, benefiting asset owners while punishing those reliant on cash income. He believes that the government's inflationary policies are a deliberate strategy to avoid making difficult decisions regarding spending cuts and fiscal responsibility. While discussing potential solutions to the economic crisis, Schiff acknowledges the role of artificial intelligence in driving productivity and economic growth. He expresses skepticism, however, about whether advancements in AI can occur swiftly enough to avert a looming crisis. Although AI has the potential to enhance efficiency and output, Schiff maintains that the current economic situation is dire and the government's fiscal policies remain unsustainable. Schiff critiques the Federal Reserve's role in the inflation crisis, noting that while it returns profits to the government, this does not address the underlying issues of inflation and debt. He argues that the Fed's actions, particularly quantitative easing, have exacerbated the inflation problem. The government's reliance on the Fed to finance its deficits creates a cycle of dependency that further complicates the economic landscape. Schiff critiques Vice President Kamala Harris for her contradictory stance on Bidenomics. He points out that while she criticizes the current administration, she simultaneously claims that its economic policies are successful. This inconsistency reflects the political maneuvering that often occurs in response to public dissatisfaction with economic conditions, complicating efforts to address the underlying issues. Schiff also addresses concerns regarding electoral integrity, discussing the varying ID laws across states and the implications for voting rights. He highlights that Puerto Ricans, despite being U.S. citizens, cannot vote in federal elections. Additionally, he raises concerns about the potential for illegal immigrants to vote, suggesting that lax voting regulations could allow non-citizens to participate in elections. Schiff emphasizes the importance of maintaining the integrity of the electoral process to ensure that only eligible voters can cast ballots. Schiff argues that the government has increasingly ignored constitutional prohibitions, leading to a significant erosion of checks and balances. He suggests that this trend undermines the rule of law and the foundational principles of the Constitution, allowing the government to operate without accountability. The lack of adherence to constitutional limits can result in arbitrary governance and a disregard for individual rights, ultimately threatening the freedoms that the Constitution was designed to protect. Schiff warns that imposing a tax on appreciated assets would have devastating effects on the economy. He argues that such a tax would force individuals to sell their assets to pay the tax, leading to a destruction of accumulated capital. This would stifle investment and economic growth, as capital is essential for driving production and innovation. He emphasizes that the key to capitalism is allowing capital to accumulate, and a tax on appreciated assets would turn capital into consumption, resulting in inflation and economic decline. Schiff critiques government regulation, arguing that it leads to higher prices rather than protecting consumers. He asserts that prices are determined by supply and demand in a competitive market, and that supermarkets operate on razor-thin margins, making price gouging impossible. Government intervention distorts market dynamics, leading to inefficiencies and higher costs for consumers. Instead, he advocates for a free market where competition ensures fair pricing, allowing consumers to make informed choices without government interference. In terms of investment strategy, Schiff advises focusing on high-dividend, inflation-resistant, essential businesses. He believes that during inflationary periods, companies that can maintain or increase their dividends will provide a reliable income stream. He emphasizes the importance of investing in businesses that produce goods and services in demand, particularly those that can pass on rising costs to consumers without losing their customer base. He suggests that investors should look for companies with strong fundamentals and pricing power, particularly in sectors that are less sensitive to economic downturns. Schiff predicts that a decline in the dollar's value will lead to significant inflation and a potential exodus of capital from the United States. He explains that as the dollar loses its status as the world's reserve currency, confidence in the dollar will wane, prompting investors to seek alternatives. This could result in a rapid depreciation of the dollar, leading to skyrocketing prices for imported goods and a general decline in living standards. He warns that this scenario could create a crisis where individuals and businesses flee the dollar, exacerbating economic instability. Schiff discusses the importance of identifying valuable stocks in promising sectors as part of a sound investment strategy. He emphasizes the need for thorough research into companies and industries, focusing on those likely to thrive in an inflationary environment. He suggests that investors should look for sectors that can benefit from rising prices and demand, such as commodities, energy, and essential goods. He encourages a value-oriented approach to stock picking, where investors seek out undervalued companies with strong growth potential. Schiff advocates for investing in physical bullion as a means of preserving wealth and protecting against inflation. He argues that gold and silver serve as a hedge against the devaluation of fiat currencies, providing a stable store of value. He distinguishes between bullion, which he views as a form of savings, and other investments that can generate returns. He encourages individuals to hold physical gold and silver as a safeguard against economic uncertainty, while also considering equities that can provide income and growth in a challenging economic landscape. Schiff also addresses the challenges faced by individuals juggling multiple jobs while struggling with financial instability. He shares insights into the realities of living paycheck to paycheck, emphasizing the psychological and emotional toll that financial stress can impose. Many individuals resort to credit cards as a means of survival when their income is insufficient, leading to a vicious cycle of accumulating debt and higher interest payments. Schiff discusses the lack of savings among those in precarious financial situations, arguing that without a financial cushion, individuals are vulnerable to unexpected expenses. He stresses the importance of building savings, even in small amounts, to create a buffer against unforeseen circumstances. Additionally, he advocates for greater financial education, emphasizing the need for individuals to understand budgeting, saving, and managing debt to empower them to break free from the cycle of financial instability. The conversation also touches on the societal implications of widespread financial instability. Schiff argues that when a significant portion of the population is burdened by debt and lacks savings, it can lead to broader economic issues, including decreased consumer spending and increased reliance on social services. He suggests that this cycle of debt and financial insecurity can hinder economic growth and stability. Schiff notes the stigma associated with financial struggles, pointing out that many people feel ashamed of their situation. This stigma can prevent individuals from seeking help or discussing their challenges openly. He encourages listeners to break the silence around financial difficulties and to seek support from community resources or financial advisors.